What's up guys, Hamilton here. So in my last video I talked about GameStop and the massive short squeeze that was happening there. If you didn't catch it, go check it out later, I've linked to it in the description below. Well, today I want to talk about AMC, the US movie theatre chain that struggled amidst the global pandemic. In early January, shares in AMC were trading as low as $2 per share. Now they've risen sharply against what can only be described as retail FOMO. Seeing the short squeeze and cataclysmic rise in share price of GameStop, retail traders began looking for other small caps with a large short interest that they could run up. And it's not just AMC. The infamous subreddit Wall Street Bets set its sights on a bunch of other small cap stocks such as Express, Naked and Sundial. So what the hell is going on? Let's find out. Here's as of yet unseen footage we captured of the situation. Over the past month, the business world's attention has been hijacked wholesale by an army of amateur traders looking to make fools of the traditional finance industry. Just about everyone from Elon Musk to Mia Khalifa is jumping on the bandwagon. Even Logan Paul had something to say about it. AMC shares exploded, and no, people aren't going to the movies more often. There are a few theories floating around as to why this happened. First up is the stick it to the man theory. This theory suggests that these traders are motivated primarily by their disdain for suits, the longtime wardens of Wall Street who Redditors argue exploited the little guy to get filthy rich. As Bloomberg's John Authors writes, the people investing today are driven by righteous anger about generational injustice, about what they see as the corruption and unfairness of the way banks were bailed out in 2008 without having to pay legal penalties later, and about lacerating poverty and inequality. Next up is the everyone's super bored theory. Without much else to do during the pandemic, people have turned to the stock market as a form of entertainment and to make a lot of money. Last summer, individual investors accounted for roughly 20% of the stock market activity on average, up from 10% in 2019. Thirdly, the Robin Hood theory. The rise of the amateur investor can be tracked back to Robin Hood, the app that pioneered no-fee trading and empowered individual investors to influence the stock market like never before. And finally, there's the Mumification of society theory. Some observers have linked the behavior of Reddit's trading army to other online communities like 4chan that engage in astroturfing campaigns. If you can create enough hype around something through memes, conspiracy theories, and harassment campaigns, you can manifest it into reality via capital. Hats off to AMC management for taking advantage of the situation. When the stock spiked, AMC issued 44 million shares as investors opted to convert $600 million of convertible debt, putting the company in a much stronger position going forward. But what's a fair price for AMC? Well, movie theatres tend to trade between 5 and 10 times EBITDA, and with the box office closed, it's safe to say we should be conservative. But looking ahead, when theatres do eventually open, a breakout year for the box office and an 8 times multiple would still only give us a fair value of around $7 to $8 per share for AMC. That's not to say the stock won't go higher, as we've already seen it climbed over $20, and with retail traders gunning for hedge funds, we could see another epic run that sends AMC back to $20 per share. In fact, all AMC need do now is announce the launch of a new streaming service or blockchain-based ticketing system, and the stock could hit $1,000 per share. Obviously, this is a joke. But with outstanding short interest in AMC reported to be as high as 80%, we could see another rally in the stock within the coming weeks or months. I see near-term upside as high as $15 per share with the downside to $4. But bear in mind that the fundamental difference between AMC and GME is that there's been no structural change in management or business model when it comes to AMC. And without that as a catalyst for long-term growth, I only see this as a near-term trading opportunity. The reality is the Fed's actions have resulted in a raging bull market for US equities, and the hubris of hedge fund managers thinking they can short such huge percentages of a stock's float left them wide open to an arse whooping from retail traders. Wall Street Bets and its nearly 8 million members only need to trade $100 a piece to have an impact on these stocks, even less with options trades. And with $2,000 stimulus checks inbound, there's no telling how crazy this bull market could get until the Fed stops the money printer. Whilst you may think it's an exciting time to jump in and be a part of the movement, remember that it's never a good idea to chase headlines. The time to buy these stocks was when they were out of favor. In fact, some of my favorite investing ideas revolve around stocks that fall out of favor. As long as the fundamentals are good, you can pick up bargains when people start selling just because they don't like a stock. But let me caveat this by just saying never try to catch a falling knife. You want to wait for a stock to settle before you dive in. So if you do plan on chasing headline plays, be aware that stocks tend to take the stairs up and the elevator down. Whilst valuation matters in normal market conditions, this market is anything but normal. Stock market valuations are high at the moment, but they're actually reasonably priced relative to record low interest rates. Be aware that this could all change. Stock prices could collapse if central banks so much as hint at raising interest rates. One thing's for certain, don't fight the trend. The market can remain irrational longer than you can remain solvent, and in this market, it only ends one way for shorts.